Now, we talked a little bit earlier about the zero-sum game. Here are some charts that we produced that appeared in the Vanguard UK Case for Indexing white paper that came out in Q3 last year. What they're putting into practice is actually looking at real funds, real numbers, and you can see those normal bell-shaped distribution curves appearing. You've got the number of funds that are outperforming, the number of funds that have underperformed, and you've also got, for each time period, 5 years, 10 years and 15 years, you've got the figures added in there before and after taking into account survivorship bias. But the sorts of numbers that are coming through over 5, 10 and 15 years is that 60, 70, 80% of funds are actually underperforming the market average. And that's really why the data suggests that passive fund investing works. One of the themes that we explore in the Advisor as Alpha paper is that the important thing from the advisor perspective is getting the client's asset allocation right, getting the client into the right tax wrappers, so making sure that tax and costs are not eroding the returns that they're getting, and also adding value in terms of the relationship that they have with the client, looking at the goals that the client's trying to achieve, rather than focusing time on picking funds. This is just some more data that takes the equity case into the fixed income market and really says, does this same pattern of returns appear both for equities over 5, 10, 15 years and for bonds over 5 and 10 years? And we're seeing those typical bell-shaped curves with the same sorts of numbers associated. Now, one of the misconceptions about passive fund investing is that it doesn't work in certain market environments. If we're in a bear market, one of the things that's often thrown back at the passive fund manager is that because you've got to follow an index, because you've got to follow a benchmark, you don't have the ability to not buy the stocks whose share price is falling. Now, this is actually some data that goes back to the early 70s and looks at all the bull and bear markets that have occurred over that time period. What it really illustrates is how difficult it is, one, to predict that the bear market is going to happen, and secondly, to understand what the effect of that bear market is going to be and identify the stocks that are going to underperform. So although the theory suggests that you should be more agile in an active fund and able to choose which stocks to invest in, the difficulty for the investor or the fund manager is actually identifying that the bear market's going to happen, and secondly, buying and selling the right stocks at the right times. And indexing, passive fund investing indexing, provides an environment that has performed favorably relative to active management throughout various market cycles, whether that be bull or bear markets. So we've had a look at some market examples, we've had a look at some data. Obviously, over the last 10, 15 years, an awful lot of advisors have focused on picking funds as a core part of their client promise. So the client promise is, what are you actually going to deliver to the advisor? What benefit do you deliver to your clients? And that advisor, back in the 1990s, a lot of that proposition, perhaps, the analogy would be that it revolved around choosing the right product for a client. Now, one of the difficulties with choosing the right product for the client is that, as we've all seen in a number of environments, buying holidays, buying cars, buying insurance, anything that can be commoditized has very much been taken over by the internet. So people can search through and identify products very, very easily now using the web. A lot of advisors then move their proposition and their client promise onto, I'll pick the best funds for you. And that's been particularly difficult, as we've seen, and the data suggests that that's difficult to do consistently over time. If we look at some actual funds, these are the returns of funds from the time period January 2001 through to December 2005. So again, they're taking a 5-year time period. In the UK market, UK equity funds which were the best performing funds. And you'll see that the top ranked fund was the Rathbone Recovery Fund, returning an excellent 98.56%. And we've shown here the top 15 funds. Now the interesting thing would be to say, first of all, who was buying those funds in 2001, but equally, what sort of flows and who was picking those funds when they appeared at the top of the rankings in December 2005. What we've then done is take that forward a stage and say, well, over the next 5 years, how did those same funds perform? And that top performing Rathbone fund actually became the 166th ranked fund out of 300 and returned minus 41% over the next 5 years, having returned 98.5% in the previous 5 years. And all this is showing is that real divergence, that real change from which funds were performing well in one time period to another, and just reinforcing the fact that in the real life, it's very, very difficult to pick winning funds. There are some funds in there that are consistent, and hopefully, as advisors, some of those were the funds that you were investing in. But it's difficult to hang a client promise around two things. One, the markets, which is something that advisors don't have any control over, and secondly, being able to identify which funds are going to perform well. Only 33% of the funds in that IMA all-company sector outperformed the FTSE All-Share over that 5-year period. So again, this is reinforcing the numbers that we saw in the earlier slides. In real-life examples, only 30% of funds outperforming the average market return. Now, I referred in the agenda to the idea that picking an index manager is not just a case of outsourcing and having nothing to do with that selection. All passive and indexing managers are very, very different. And that's really one of the things that 7IM were trying to do in running these roadshows, was to provide some generic education around passive fund investing. In simple terms, I think Vanguard provides the easiest to understand solution in that we're offering a mutual fund as the way to access the market return. But even within that sector, not all index managers are the same. And the sorts of questions that you need to be asking a passive manager is trying to understand their scale and expertise. As I mentioned earlier, John Bogle and Vanguard founded the first index mutual funds that were available to retail investors back in 1975 in the US. So in effect, mutual fund investing is our home game. One of the things that also comes through is that it's the actual total cost of investing that really hurts the client in the long term. So you need to understand what those costs are. And as well, there's an awful lot goes into how you actually manage the investment. Which benchmarks do you choose to track? Is it total return, net return? Are you looking at all the funds that are accessible in a market? Do you choose to track the FTSE All-Share or the 350 or the 250? So there's an awful lot of effort goes into choosing the right indices to track. In terms of the way that you track funds, do you aim for full replication? Do you buy the whole market? Or do you choose to optimize and buy a selection of stocks or issues in that market that reflect the market as a whole? And one of the things that I think our ETF contributors later in the day will talk about is the whole idea of securities lending, the counterparty and collateral risk that are associated with those areas. But fundamentally what it's all about is how good are you at tracking? How accurately do you replicate the benchmark and the index that you've chosen to track? And all of that really needs to be put into the context of what's the benefit to the client of the way that you do those things. And one of the conversations that we'd be happy to do at Vanguard is explain in one-to-one meetings how we do what we do. Vanguard launched their range of funds in the UK back in June 2009, and we now have 14 funds in our range. They're split between fixed income and equity funds, and they cover most of the major markets. One of the things that you'll notice from here is that we aim to be very transparent as far as the client's concerned. I think Peter later on in his presentation will talk about the way that Vanguard charges the client the stamp duty reserve tax. Obviously, stamp duty reserve tax is something that every UK investor has to pay. It's something that the HMRC collect. One of the things that Vanguard has introduced is the way that we charge that to clients on the way into the fund. So although our funds have no initial charges, anybody investing in the UK all-share fund and the UK equity income fund would typically pay 0.5% stamp duty. That's something that every investor will need to pay. And we think that it's more transparent to do that every investor does that on their way into the fund, rather than tying that up that the investors that invest in the fund pay everybody else's stamp duty later on. We aim to be very transparent, as I say, as far as investors are concerned. So we will show the investor the initial charge, the preset dilution levies that they might need to pay in order to access the stocks or issues in a particular market. And one of the things that we've also introduced is that our AMC will typically equal our TER. The range of funds in the UK, the average TER is around 0.28. As I mentioned earlier, that FTSE all-share fund has a TER of just 0.15. We'd obviously be happy to pick up one-to-one with any advisors around that fund range. So really my aim today was to illustrate the zero-sum game, or as Charlie Ellis referred to it, the loser's game. The data suggests why passive fund investing works. We believe that it's extremely difficult for fund managers to consistently outperform the index once costs are taken into account. A lot of people will throw up the fact that indexing doesn't work for a particular asset class or a particular market cycle. And one of the things that you'll be able to refer to in the UK case for indexing paper is that we've suggested that the data suggests that passive fund investing can work across all asset classes and timeframes and bull and bear markets. But I think the key thing to focus on today is the fact that as a financial advisor, you have a great opportunity to add value for your client in the relationship that you have with the client, the choosing the right asset allocation, getting that right for the client, implementing that, making sure that that's rebalanced on a regular basis, making sure that you choose the right tax wrapper for the client, making sure that you understand the client's goals. And what we provide with indexing is the ability to pick the funds and outsource that piece and make sure that that happens in a consistent way. So you're not having the risk of having to keep picking winning funds. And I think that fits with 7IM's approach of outsourcing that investment management solution. Thank you for your time.